post-COVID lending program panel discussion today. I'm Bill Brennan. I'm with Pizzuti Companies, Executive Vice President and CFO. Want to take time and make sure that everybody's got audio turned off, cell phones turned off. Want to be respectful for our panelists and also the folks listening. Everybody should be muted, but just in case. We're very excited today to welcome three esteemed panelists here in our Columbus market. All bring a very, very different perspective to the market. And I think it gives us an opportunity to hear what is going to look to be three very different perspectives and opinions and future trends on the market and where we're headed here in Columbus. So I'll take a moment now to introduce our panelists. First, we've got Leslie Biskner. Leslie's Executive Vice President, Director of Marketing of the Commercial Lending Group with Cooperative Business Services here in Columbus. Cooperative Business Services provides commercial loan financing in partnership with more than 120 credit unions. I think it's important with Leslie's perspective and the fact that she works closely with 120 credit unions that we're going to see today and hear today from Leslie that she's got a very unique perspective on where the current market is locally here in Columbus with that group of lending partnership. Our second panelist is Chad Kiner. Chad is Managing Director with Walker & Dunlop, also based here in Columbus. Walker & Dunlop's a national mortgage brokerage firm that handles significant financing transactions across the country. Chad joined Walker & Dunlop in in January of 2020 as part of the MSF Real Estate Capital acquisition. And then last on our panel, but certainly not least, is Joel Lilly. Joel is Principal and CFO of Thrive Companies, a developer here in Columbus, engaged in several prominent large mixed-use urban developments. And usually when you hear large urban mixed-use developments, that means there's a lot of brain damage associated with it. So I think the three perspectives, as I mentioned earlier, that we're going to get today are very unique and very different. And I think I want to appreciate the work that the NAIOP committee has done to bring, Joel, Chad, and Leslie to our panel today. So with that, we're going to approach today's conversation as just that, a conversation. We want to try to address three overall themes today. One is the overall macro lending market post-COVID here. The second theme we want to touch on is sort of a little more micro on how banks, insurance companies, and the agencies are approaching underwriting and approaching deals and approaching financing in today's current environment. And then, like most panels, we want to take an opportunity at the end to think about future trends, look ahead, third quarter, fourth quarter into next year, and have a conversation around where we think the lending market is headed. We'll also have time today for a Q&A. Obviously, that's done virtually. Folks have a chance to use the chat feature and post questions. I'll keep an eye on those as the forum and the panel unfolds, and we'll make sure we try to address as many of those as possible to the extent we haven't addressed them in the questions that we've put together today. So with that, why don't we start with an overall macro market perspective here in Columbus. When we think about Columbus and where we are, in our real estate cycle, let's discuss how Columbus is faring compared to the rest of the country. Let's start with you, Joel. Can you give us a perspective on how Columbus is faring compared to the rest of the country?
Sure. So thanks, Bill. Thanks for the introduction. So, I think Columbus seems to be faring very well compared to its peers, probably are as good as its peers and probably right now doing better than some of the larger cities. We were doing very well as a city prior to COVID happening. I think with COVID impacting things now, I think we are absorbing that with the influx of people that have been, I think, driven out of the larger cities. It was happening maybe with some tax policy changes that happened a couple years back, but then also I think those trends were accelerated with COVID and some of the other things going on in the country right now. And I think Columbus is benefiting from that, and that's helping absorb some of the negative impact of COVID.
Mm-hmm. Chad, when you think about the national perspective that Walker & Dunlop has, share with us a little bit of the perspective on Columbus from a national view.
Yeah, it's interesting. One of the reasons why Walker & Dunlop approached our company previously about acquiring us was they didn't have a presence specifically in the Midwest. The closest office is in Chicago, which obviously is technically the Midwest, but was not represented in Ohio, Kentucky, Indiana, Western PA, and with the exception of one or two people in Michigan either. So they viewed Columbus specifically as a great hotspot to grow the platform because we're one of the only positive cities in the Midwest with positive population growth. certainly a lot of demand drivers here from state capital, government, insurance industry, banking industry, and whatnot, and so on and so forth. And felt like it was an area from a cost of living perspective that was very affordable. You had educational capital, ability to hire a good workforce because of Ohio State, and the other schools and universities around our region. And there's just been a lot of job growth here. So that was really sort of the entry point for us coming into Columbus. And I think as this COVID crisis pandemic has moved on over the last 2 or 3 months, interesting thing that has been happening is we've had several people within Walker seek relocation to the Columbus office, and not specifically working for our team, Jeff, AJ, and I, but more for reporting to their existing bosses. We have one person that's relocating from Dallas, and he is a Columbus guy, born and raised here, and he saw this as an opportunity to come back. So he'll be working out of our office, and then we're having another person on an underwriting side relocate from New York. So, and I know I'm sort of answering your question in a lot of different ways, but really what this is showing me, and I've had a lot of discussions internally about this and externally, because of the cost of living in Columbus and the sort of the isolation that we have compared to some of we're not as dense as some of the larger cities. Are we going to see, and this is a discussion we've had as a company as well, are we going to see transition from the bigger cities or relocations from the bigger cities to cities like Columbus? And I think Columbus ultimately is going to benefit from that.
Great. Appreciate that, Chad. Leslie, let's get a little more granular on, the current approach and attitude of lenders here in our market, specifically sort of credit unions and banks, with the perspective that you bring. Talk a little bit about how you all are approaching the market, how you're looking at approaching loans, and how you're looking at approaching, the current lending environment.
Sure. Thank you so much. Also, I want to mention for all the 13th century fans out there, sadly, the medieval fair and marketplace opening has been postponed. So I'm sorry to inform you of that today. I wanted to kind of mention that I've got some statistics here so I can give you a perspective of the types of projects that we work on. And I wanted to mention that our average loan size for the credit unions on the commercial side in 2020 is about 1.581 million, which I'm sure is a sharp contrast to the amounts of loans that Chad Kiner works on or Joel works on, but that is actually up from 2019 stats. So we're seeing some larger loans come through the credit unions this year, and we're actually seeing more volume. This time last year, the credit unions closed 91 commercial loans. Today we're at the end of the month, we were at 138. So our lending perspective hasn't really changed. Our underwriting guidelines haven't really changed at all this year. And I know, I think one of the questions in this conversation will include deferment. And I can either talk about that now or we can wait till a little bit later. Bill, it's up to you.
Certainly, Leslie, why don't we approach that now?
Okay, let's talk a little bit about that, because as you know, and I'm sure my partners here on this call will recognize, is that hospitality is probably our toughest industry right now. What we're seeing is, if I share a few statistics, we're at about, in our portfolio, we're at about 30% in deferment on hospitality, which, without sharing any specific numbers, is a fairly large amount. Many of them did go on 6 months deferment rather than 90 days deferment. And we're now in discussions with our borrowers to determine whether or not they need additional time going forward. And it'll be interesting to see what the governor says this afternoon when he addresses our state. So I think, if anyone has any specific questions about deferment, we can, address those at the end of the conversation.
Mm-hmm. Joel, when you think about construction loans in today's market, what's your perspective? Are banks making construction loans? Are they providing leverage where leverage might be needed for projects to pencil out? Give us a little perspective on that.
So yeah, we're closing. We've been closing loans during the COVID time, and we are actually out there seeking term sheets on some of our pipeline projects that we want to close between September and October this year, and we're getting reasonable terms. Most of what we do is multifamily. We do have a little bit of office and a very little bit of retail. So multifamily, I think, has been trending very well based on the current market conditions. I mean, we've got very minimal impact from loss of rent, and so I think that helps when you're talking to the banks and able to tell them and share with them your current statistics with high occupancy, low delinquencies, and so I think that helps when banks are underwriting these deals. And we all know that this whole business we're in, you have to do loans because we need loans and banks need to give loans, and you just try to find the right projects that have the right sponsors and the right underwriting and the right location. And so we are finding ourselves, I guess, benefiting from banks continuing to be in the marketplace. I think April, May, and June were very strong from a multifamily lease up and occupancy standpoint. For us, it's going great, but you just never know when other things can happen with COVID and the longer it goes and how it impacts individuals, and when government incentives and other things run out, whether that impacts us. We're not seeing it right now. We're hopeful that we'll get through this and we're at the low point and it gets better from here on out. But so far things are going pretty good on our banking interest on our deals.
Great. So we've heard from Leslie. She's talked about how banks or in the credit union world is proceeding. Still closing a significant amount of loans. Joel, you mentioned we still have the ability to source construction loans here in our market from the banks that are here. Chad, what about the permanent loan market? The takeout market, if you will, for projects on the new construction side, or the refinances and the acquisitions. Talk about how the insurance companies are approaching, our market specifically, and what kind of lending, they're looking at doing. Even touch on the property types if you could, and then likewise, Fannie and Freddie. I know we read a lot about them and how active that they've been, but help us kind of bring it to the Columbus market and provide context on both of those fronts.
Yeah, so certainly, Bill. Mixed bag, to be honest. I would say probably about 60, 90 days ago or so, and my time could be a little off there. Life insurance companies primarily put their lending on pause, and that was no surprise. I mean, there's a lot of uncertainty in our market. Corporate and muni bond rates for a period of time really, spread out pretty significantly. Interest rate caps or floors, I should say, were raised a little bit, and that was a way for life insurance companies saying, "Hey, you know what? There's so much uncertainty in the market. We're not lending today." Over the past 30 to 60 days, however, we've seen them slowly re-enter the market. But I wouldn't say guns a-blazing by any means. They're being very selective still in their financings and in their quotes. Leverage levels have been pushed down where before, there were insurance companies out there that you could find full leverage 75% for the right insurance companies, for the right deals, certainly the Class A type of properties, in multifamily specific or mixed use, where today maybe we're at 60, 65%, and you can find a needle in a haystack at 70%. Pricing is starting to come down a little bit, but I would say overall the general theme is life insurance companies have not returned to pre-COVID. Certainly there's a lot of uncertainty out there in the market, and I think that's going to continue. And until the market stabilizes, I don't see them returning to where they were pre-COVID. Now, certainly deals to get done, just a little bit more difficult to get done in that arena. Freddie and Fannie and HUD for that matter, but mostly Fannie and Freddie, because I think that's those two lending platforms are a lot more familiar to people on this call, have been, what you would think they were. They're a source of capital, and they continue to be strong. They have put in reserve requirements, interest rate requirements in terms of interest rate floors and whatnot that have made it a little bit more difficult. So the programs have changed a little bit. Cash out's a little bit more difficult. For a certain period of time, Fannie was really strong. Freddie was more on pause. But we've seen that change over the past 30 days where Freddie is starting to get back in the market and in some cases being a lot more aggressive than Fannie. So, we go back to 2008 and even before that, 10 years, 1998. And that's really when I entered the industry back then is, during the downtimes, you can always rely upon Fannie and Freddie. And that has definitely been the case over the last 30 to 60, 90 days. And we will continue to see that happening the rest of this year and into 2021.
Great. Good to know. They also say you make your best loans during a downturn, right? So I think we'll hopefully keep our focus on that over the next several months.
Yep.
Leslie, when you have borrowers approach you and they want to talk about, financing and getting a loan on a property type, are there any property types today that are really challenged? We heard about hospitality. You mentioned that earlier, but we hear a lot about retail.
Yeah, one of the toughest ones after hospitality are daycares. They're not operating at full capacity. I think there's maybe 9 children allowed per classroom. They've got deflated revenues and extra costs associated with cleaning measures, daily basis or even an hourly basis. Most of the owners that own it as commercial real estate as an investment where they have a tenant have negotiated some sort of payment rent relief with the daycares themselves. So we are, we're a little bit hesitant on working on any type of new daycare project. And then low-income commercial real estate, multifamily. I know Joel talked about multifamily in general, but due to the eviction stays, we just kind of don't know what's going to happen when that gets lifted at this point, with occupancy at the lower income apartment complexes. So we might see a trickle down effect in delinquencies based on that. But restaurants, in general, some are doing really great. I mean, you've got DoorDash and, a lot of delivery services, drive-throughs. I've been to a couple places where they've got car slots, 1, 2, 3, 4, 5, 6, 7, 8, because they get busy on a Friday afternoon. We recently financed a project. We closed it in the middle of March. It had a gym, a gastropub, a hair salon, and a catering company. So all obviously were impacted, but we did something kind of unique on that project whereby when we closed the loan, we offered interest only for the first 90 days right out of the gate to kind of give the property owner some relief as he was moving forward. So we'll see what happens.
Great. When we think about new loans coming in, whether Joel, you've got a loan you're taking in, or Chad, you've got folks approaching you, I'd like for the two of you to talk a little bit about the underwriting guidelines today, loan to values, loan to cost, both from a construction perspective, also from a permanent loan perspective. Are you seeing tightening of those standards? Are you seeing leverage levels coming down? I know a couple of you have touched on it already, but any material changes in how banks and insurance companies are underwriting, their loans these days, and kind of see how much detail we can get into as it relates to just sort of leverage levels and covenants and so forth.
Joel, you want me to kick it off?
Sure.
Yeah, I would say, Bill, sort of as a piggyback to what we were talking about before, of course, certainly, yeah, everything is being more scrutinized than it was before. Leverage levels have come down. Columbus has always been a unique market on the construction side where we've been a higher leverage market. If you compare our market to Florida, for instance, where the loan to cost on a multifamily deal is you're lucky to get 70% in that market, maybe 65%. We've always been a market where for the right deal, it's an 80 to 85% loan to cost market. And we've definitely seen that come down back to the pack a little bit. And not that those other markets are probably being a little bit more squeezed as well, but specifically to Columbus, I would say in multifamily, and there's probably a lot of people in this call that have multifamily experience or connections and whatnot, but it's more or less a 75% loan to cost market right now on the construction side. So leverage levels, I think that's sort of in multifamily is a darling still of real estate asset classes when you compare it, and for a whole host of reasons, I'm sure we'll get into it, but we've seen it come down on the construction side. We've seen it come down on the life insurance company side. We haven't seen it come down on the agency side, but there's been more restrictions on the agency side where before it might be a little bit more attainable to get a higher loan to value, but based on certain metrics and covenants and not covenants, but different metrics and cash out and whatnot, it's definitely squeezed compared to how it's been prior.
Yeah, so just, I would agree with everything Chad's saying, and actually Chad's helping us out on some loans right now, so we're seeing the same term sheets on some of these deals. And I would agree. I mean, we're in that zone, and I think it's really driven by banks. I mean, we are getting different term sheets with different numbers on the same deal. Middle tier banks, community banks versus the larger banks. I think, the larger banks, in my opinion, have always had a history of being in a box and hard to get outside of that box. And I think they're a lot more risk adverse. And I think the community banks for Columbus, which has made it really good for developers in Columbus, are very aggressive. So I think that they will probably always be, 5, percentage points, maybe a little higher than that from a loan to cost perspective. We see the larger banks being in that 65 to 70, and we're seeing the middle banks being in that 75 to 80. And I think it's not only tied to the banks themselves and their appetite and their capacity and where they are at with, loan balances and payoffs coming up and what their interest is, because every bank has their own interest. But then I think it's also just the product you're doing. I mean, you're multifamily versus office. Is the office pre-leased? How good the credit is? Is it retail? Is the retail pre-leased? I think all those things drive into that, and it all comes down to the site and the sponsor and the risk level. And, we've, from a historical perspective, how we handle a lot of our developments, they're larger developments, 30, 40, 50, 60 acres. They take longer time to get developed and to get to this point. And, one of the projects I'm working with Chad on right now is we've owned it for quite a few years. We've done a lot of brownfield remediation. We spent some time and energy and made a lot of improvements with some economic incentives, and we're getting the benefit of some of that equity that's in there, whether it's sweat equity or cash equity, but getting the benefit of that. And I think we can, help get creative on the capital stack and kind of push those limits on loan to cost. But I think, if you're taking an average number, you're probably in that 75% loan to cost and probably in that 65 to 70, percent loan to value. It just, again, it all is driven by the appraisals too, and how they get underwritten from that perspective.
Mm-hmm. Joel, that's a good segue. When you think about appraisals and that valuation process, how do you all see appraisals impacting lending here in the short term, if at all?
Yeah, so on the appraisal side, obviously every deal is so dependent on that appraisal process, and appraisers underwrite them differently. But I think a lot of it's driven from comps, which is where they get all their support. And, I think appraisers for the most part are typically a 3 to 6 month delay, and it works on both sides. So I remember during the recession era, having banks look at stuff pre-recession, post-recession, and now we're pre-COVID, post-COVID. And, they're grabbing comps that are, 6 months old or a little older and using that for their basis. And so any immediate impact from COVID in the last 90 days, they're all writing that into their appraisals as a potential impact, but they're taking sales comps that were closed prior to COVID and they're basing it on that. And I think 3 to 6 months from now, maybe we see a little bit of a pull down on that. But right now, talking to sales brokers out there, and again, as we talk about multifamily, the cap rates haven't gone up. Interest rates are low right now. They've been low, and we hear that they're going to probably be low for the next 18 to 24 months. So, and that's probably the biggest driver of cap rates is the interest rates. So I feel like, from an appraisal perspective, if you do a good job of underwriting your performance and going out to the market, I think, as long as know what you're doing from a valuation standpoint, you're not getting too aggressive, you're probably going to get appraisals that support your underwriting, and you'll have comps to support it.
Yeah. Leslie, let's talk a little bit about the time frame for closing loans. Let's rewind a little back in March when, the pandemic started, and then in April when we started seeing some of the government incentives coming out and, the CARES Act and the PPP loans and so forth. I know your organization was very active on that front, but, fast forwarding to today, Are you all still processing loans? And do you see in the market in Columbus here that loans are still, proceeding and closing under reasonable timeframes? Do you think there could be future delays as more incentives may or may not come in the future and some of the unknown is starting to get answered? Give us a little bit of color and context on that if you could.
So in March, when we were closing loans, our biggest delays actually were from the appraisers, because some of them were under direct orders not to enter into buildings, because if they were operating, if there's employees in it for a refinance or a purchase. And so some of our appraisals were delayed by 1 to 2 weeks until proper, I guess, safety protocols were put in place at those particular companies so that people could enter and assess the property. But overall, for the most part, we've had, at our credit union co-op, we've had 2 straight record months of closing loans, pretty much in the history of our company. So we're not seeing delays, except we are in a few instances in Kentucky and Indiana. And it's because we're having problems recording our mortgages, because appointment times are limited to 3 hours, et cetera. But in Ohio, we're not really experiencing those issues. I mean, it seems to be fairly normal. I don't know if Joel and Chad agree with me as far as timing and delays and amount of loans closing. From our perspective, it really hasn't slowed down much. I think there could be a slowdown coming, but I have to remain optimistic.
Mm-hmm. That's right. Joel, Chad, are you seeing the same things? Are you all feeling like the process is moving along as it should in a reasonable time frame, or do you see impacts, out of the control of your purview?
Things are certainly being impacted and they're taking longer. I mean, Leslie touched on it: inspections, the coordination, the safety of tenants, the title recordings. We were in the middle of a closing in March, and 2 days before closing, the title or the county closed its recording offices. So we had to wait a week. And that's a small example, but things are taking longer. I do feel like as well, with everyone working remotely right now, the ability to collaborate with your team is slowing things down as well. Certainly, I know everyone's taking measures the best they possibly can to do Zoom calls or to communicate as much as possible, but it's inevitable. Things are just going to take slower and longer to get done. A lot of the lenders that we work with, they're working remotely, and they're having the same challenges. So you add everything up, things are definitely taking longer.
Yeah, I would agree with that as well. And again, you hit on it, Chad, with the whole county auditor and things getting recorded. I mean, we were doing a lot split for a loan that we closed on April 1. And, we were trying to get that closed in March and just trying to get the things that we needed from a transaction standpoint. And because we were breaking out a parcel on a larger development to get that multifamily loan closed, and closed on April 1, and then we closed on a condo loan April 20th. So right in the middle of probably the worst situation with COVID. And we were dealing with banks that we had dealt with before. And I think that drives a lot of this, because I think it's one thing to, have a deal take 90 to 120 days that you thought was going to take 60 to 90, which is more the traditional time frame. But that's all coming back to the relationships with the banks. And I know from our perspective, we look at banks and like, hey, we want to deal with somebody that we have a good relationship with, that we know isn't going to change the deal on us at the last minute. So to me, when we're looking at term sheets, we're not always trying to get the best, most aggressive deal. The relationship with the bank and knowing that they'll be able to get something closed, and when they say they're going to get it closed, they'll perform, is more important than anything else on any term sheet. So we'll give up dollars to make sure, we're going to be able to execute. And, for us, we're never, cutting it to the point where, 30 days is going to make or break the deal. We just, like anything else, the quicker you can start, the quicker you can get vertical, the quicker you can get it leased up, the quicker you can get stabilized.
Let's think about the next couple of quarters. I think this panel discussion is very timely. Bank earnings are starting to come out this week. We're seeing some announcements by some of the larger, money center, international banks putting together, pretty sizable loan loss reserves as they think ahead to the upcoming quarters. But, when we start to see that as the backdrop, Joel, you touched on earlier, Leslie, you touched on this earlier, there's lots of different types of lenders that are out there, lots of different size lenders. But, when we think about the third quarter and beyond this year, how do we feel real estate deals and lending in general, the attitude by banks is going to be both on the construction side and also on the permanent loan side? So Leslie, let's start with you. And, do you think this current environment is going to be easier or harder to find loans and, process and close loans here as we get into the latter part of this year and early next year?
Sure. Yeah. Speaking from my perspective, we have a pretty standard template to risk rate any type of project. So as long as a borrower and a property fall within that risk rating analysis, so to speak, our standards are not going to change as far as being able to give out money. What could happen, honestly, I think it might go into positive territory because my credit unions need places to place their money, to earn money. They're not going to be earning money from a deposit that's earning 0.01%. They will be earning money from the real estate basis spread on a real estate loan. So if anything, some of my credit unions have told us, that they are going to be aggressive in lending money because they need a place to put it. So, we're still going to be addressing global cash flow, property cash flow, occupancy percentages. But, honestly, our debt service coverage requirements are going to stay the same. And if folks fall into those categories with a little bit of gray area that we can mitigate, I think things will still look positive unless there's a run for the money at the banks and people start putting it under their mattresses.
And to that point, Bill, if you don't mind, I can comment on that. So I listened to a webcast last week that had the chairman of PNC Bank, and he actually echoed the same points, Leslie, which was they've seen like their low income accounts. So accounts who would typically have $500, $600 balance, their average balances were over $1,000. And I think he even said $1,200. And I think that's sort of indicative of what he's hearing from other banks as well. And what's interesting about that is, the banks make money by collecting balances, right? And then loaning them out. What they don't know yet, and it's pure speculation, and they can argue either side of the equation is the additional money from the government assistance, or is it just because people aren't spending as much, or is it a combination of both? Is that additional cash that people are holding in banks or financial institutions going to continue? So their PNC, the chairman from PNC, his thought was, hey, we're going to continue, and they're obviously not the most aggressive bank, right? But this gives some perspective. We're going to continue to be diligent in our lending. We're probably not going to lend to new relationships right now. We're going to focus on our existing relationships, our existing depositories, and we'll see how things proceed over the third and fourth quarter, because if you listen to economists, they're all predicting negative GDP growth the next 2 quarters. And when do we rebound? And we can go down a rabbit hole right here, right? But if you look at the market continues to go up. Why is it going up? Do we already have losses built in, or are we going to have some cold water thrown in our faces in the next 60 to 90 days? So I think everyone is just proceeding with caution right now. But it is interesting that banks do seem to have more liquidity now than they typically would have.
Joel, do you think there's going to be, to Chad's point, do you feel as a developer there'll be more liquidity as we approach the second half of this year for the front end new construction, and then maybe Leslie and Chad, you can touch on sort of the back end, but thinking about the loan loss provisions that are being built up, ideally everybody is sort of planned for that, and now they can look toward the future and understand that now is the time to be making loans. So what's your take on that, Joel?
Yeah, no, I agree with what Leslie and Chad were saying, and I think Leslie said it specifically about banks having to try to earn higher than just keeping balances in their accounts. And for us, I look at it as people want to get their money to work, so they want to kind of invest in deals. One of the things we noticed early on in April, everybody was like, all right, how are you guys doing? Like show us the rent roll, show us occupancies. Are you guys having any delinquencies? And then they said the same thing again in May. And I think, banks traditionally want to try to feel like they can get ahead of the curve. So they want to see problems before they start betting on these projects. So we've been fortunate enough, since April, May, and June, and July to show that we're not getting hit by that. I think you're going to see that continue to be a big question by lenders to where are you guys at with your current inventory? Are people still paying rents? Are you seeing a rise in delinquency, especially as we approach towards the end of the year as unemployment runs off? I think, they're going to really be looking at that, diligently. And if they're not seeing any bad trends, I think it's going to continue to, basically invest in these projects through the downturn and hopefully to a really strong spring again next year. But if they see any kind of spike, especially between, multiple borrowers in with their client list, they're going to jump on those trends and they're probably going to start to slow down quite a bit. And frankly, from our perspective, we believe the market's going to continue to do well, but we also know we want to get out there and get these loans closed because we got construction and we know our product's not going to come online for 18 to 24 months, which will get us through the next 18 to 24 months. But hopefully COVID is just a bad memory and is behind us by then.
Let's talk specific to Columbus for a second. Most desirable loans to make by property type to least desirable. So specific to Columbus, if we could. I know we all read a lot of the national press and, certain asset classes. We've talked a lot today about multifamily being very favorable. We've talked about hospitality having its challenges. But, how would the three of you rank sort of the most desirable loans that banks and insurance companies and credit unions are making today? And then likewise, the least desirable. So if you fast forward toward the latter part of this year and the next year, which loans are going to be the most favored, and then which ones are going to continue to potentially have some challenges?
Leslie, do you want to start?
Yeah, I can tell you what my favorites are. I love working on industrial projects. They are typically 100% occupied, even if it's flex space. Tenants are fairly strong. Many of them have been deemed essential during the shutdown, which has been fantastic. And then if I were to name two of my top 10, if there are 10, I would say my second favorite is medical. So again, they were deemed essential. This could be a standalone triple net urgent care to multi-tenanted medical facility. Obviously elective appointments and surgeries were kind of put on pause, but they were one of the first things that reopened. And the occupancy rates seem to be good. And I know the cap rates are a little bit lower on these type of properties, but we're lending more money on it today than we would have maybe 5 or 6 years ago. But those are two industries that we see that will remain very positive going down the road in the future.
Great. Chad, what about you? What's your perspective on, forced ranking of these asset classes here in Columbus?
Yeah, class A-, B+ multifamily stabilized is the darling, with insurance companies and Freddie and Fannie, of course. I mean, those are the easiest assets to get financed at the highest leverage and lowest rates. I think that goes sort of without saying from that perspective. But you bookend it with hospitality would be the low end right now, based on the modifications that across the nationwide the lenders have undertaken right now. And then in between, I mean, I agree with Leslie, like industrial continues to be a darling in the industry, medical office. There's a lot of talk on what does office look like going forward? Urban office, suburban office, things like that sort. How do people work and live and play and really commute to work going forward? Has COVID changed that? So I think that's sort of a speculative investment with life companies and some certain banks right now. The retail is, I would say, goes back to history as well. What's really strong in the retail is the grocery anchored retail. And that's, if you look at the retail sector, certainly we've changed the way we spend money with the e-commerce and whatnot, but still, and Bill, you probably know the percentages, but the percentage in America, we still lag other countries in what we spend online. So how much growth do we have in there? Certainly sales have been cut back, but I've looked at a lot of grocery sales on several different deals lately, and grocery sales are going up. So the brick and mortar grocery. So I would say to close the loop, grocery anchored retail would be the darling within the retail industry. Other than that, it's just pure speculation.
Yeah, I think I would just add in there, a lot of what we do is multifamily, and we feel like that is, one of the easier products to underwrite right now. I mean, you're basically, getting market comps and market studies to support your projects. And, right now I feel, particularly in Columbus and Central Island, really the urban, semi-urban areas, that, the lease up absorption rates are great, and the demand is great, and the demand is definitely outpacing the new construction delivery. I mean, I think there's some people out there that probably are slowing down a little bit on some of these projects. So I think that demand is going to continue to grow on some of the stuff that may have started if we hadn't had an impact from COVID. I think, as Chad and Leslie both had on too, you got the retail sector. I think the retail strictly comes down to signed deals. I mean, going out and getting spec office and spec retail financed right now would be very difficult. And I think if you've got good, strong tenant mix, you've got committed tenants with good, guarantees and support by the tenants signing those leases, I think that is certainly achievable. And again, if it's in a good location, but, going out there and, leasing a spec 50,000, 100,000 square foot building, and your sole source is the guarantor behind it, those are just going to be a lot more difficult. I think we all thought, the hotels are at the bottom of that list, hospitality. I think I'm certainly in agreement there. I look at the hospitality sector now, and we don't really do much of it at all. But I look at it as, you got lenders out there that a lot of what they do is hospitality. They probably are thinking, all right, these projects take, 2 to 3 years to develop and build and get open. And where are we at 3 years from now? I think there's mixed feelings out there right now. 3 to 5 years seems to be what people are saying. Some are saying 2023, 2024. And I've heard people say 2025 before the average daily rate gets back to where it was pre-COVID. But, you're talking 3 years from now, 4 years from now, those lenders probably understand that and can continue to underwrite those deals. And they're also getting a lot less financing. I mean, they're down at that 50, 55% loan to value, maybe 60%. They're not nearly as aggressive as some of the other lending out there. For lenders that do like 5 or 10% hospitality, those guys probably aren't doing one deal right now. So you're just losing that pool of lenders. And you got to go to the guys that, certainly that's all they do. Because again, they know that business better than the guys that don't do it every day. And they're going to better underwrite those longer term, farther out deals.
Got it.
Hey, Bill, one other thing too, to just add to Joel and Leslie's point, asset class that we didn't touch on, student housing and senior care facilities as well. Senior care have been the most hit by COVID. So there's been a huge pullback within that industry right now from a lending perspective. In student housing, it's just so much speculation going on. Are universities opening in the fall? Are they not opening? And also, the way universities are leasing out their on-campus facilities. The day of having 4 people in a little one room with one bathroom, that's not happening anymore. There a lot of the universities, from what we're hearing, are maxing out 2 people per one bathroom. So what is actually happening within the student housing industry is we have a shortage of beds on campus. So a lot more people are moving to off campus, which is potentially could make those assets lease up quicker. But I guess the point I'm trying to make is there's just so much speculation still, because we just don't know if they're opening up or not yet.
Got it.
Yeah.
Got it. Appreciate those thoughts. Just a reminder for those that are watching, we do have a Q&A feature at the bottom of your screen. If you want to post a couple questions, we'll certainly share them with our panelists and work through. Being mindful of time, we're about 45 minutes into our conversation. Starting to wrap up the discussion a little bit here. We touched on the macro market here in Columbus, still being very desirable for lenders. We touched on the underwriting guidelines and what's currently happening. Leslie, we heard from you that standards haven't changed too much. Chad, you mentioned that depending on the property type and depending on the type of lender, we're seeing some changes in leverage levels and so forth. Joel, you touched on some of the closing delays, taking a little bit longer and just things that are happening and maybe the delays in the appraisal evaluation. But Anything that we didn't touch on as it relates to our current market here in Columbus over these next couple of weeks and months from a lending perspective? Is there anything that we haven't talked about that, you all have been thinking about, these last couple of days, or anything new, because this market is shifting so much each day? You mentioned the government, and possibly making some announcements later tonight. So any thoughts that we haven't touched on for our audience that you might want to share? Leslie, anything?
Yeah, I would say interest rates. I mean, that's what's really been driving all of the new business that is occurring now. Because I mean, I just looking at the Treasury bills, which is the index credit unions based their commercial loans off of. We're talking, 3-year at 0.19% and a 5-year at 0.3. So you add a couple basis points to that, and we're talking loans that could be priced in the twos. Same with the Small Business Administration for owner-occupied projects. For those of you on the call today that work with owners and do sale leasebacks, I mean, you've got interest rates in the twos for 25 years fixed. So that could propagate a small business owner or a small business to buy their own building and move their company in there, that otherwise might not have happened a couple of years ago. So I think interest rates are a big play. And I'm sure Joel is getting good quotes on his new projects, and Chad's finding good quotes on new projects.
Yeah, that's a great point, Leslie. I mean, interest rates sort of like, they've never been lower, right? And the interesting thing is spreads are wider, but all-in rates are lower because of what Leslie said. The indexes are just they're so tight right now. So it's a great time to be in the market financing. Certainly if you have a stable project and ready to put something to bed for the long term.
So real quickly on jumping on what Leslie was saying about interest rates, where I think it's really helping us right now is we touched on it earlier too with debt service coverage. I mean, we all, I think, would agree that debt service coverage is going to drive every loan amount more than anything else on a term sheet. And so when I look at debt service coverage and I'm talking to banks about what that test is, we're benefiting from the fact that interest rates haven't moved a lot in the last couple of years, and we don't think they're going to move a lot in the next couple of years. They're putting in those interest rates for their long-term speculation of when they're going to get paid off and what the permanent market's going to be like. Those numbers aren't going up. I mean, pre-COVID and probably for 3, 4, 5 years ago, people kept wanting to test it at 6.5%, 7%. Like, we know rates are going to go back up because they can't stay down this low. Now we're seeing those tests with 5.5%, 6%. And it's helping us when you have to meet a 120, 125 debt service coverage, getting to use that lower, rate on, something that they're speculating 24 months from now helps, kind of maximize those loan dollars. So I think we're benefiting from that. And then, to touch on too, just, what I worry about is we all saw what happened with the closures and the ripple effect there. And certainly it seems like we're collectively thinking we've absorbed that. What should trump everything is health. But you just worry about, a major change again and going back towards the way it was in March and April. And I just worry about Columbus and every other city absorbing, another turn of that, because we've got all those incentives that are out there that, help get us through to this point. But, if there's if the higher people decide that that's what needs to happen, it's probably the right thing, but it could, we could be saying some different things on another panel, 2 months from now, if that's the case.
We talked a lot about the third quarter and the fourth quarter. No one has mentioned yet the fact that we're in an election year. Any feedback from banks and lenders about, I won't even say anything's typical anymore, but sometimes the traditional approach toward an election year, which is, hey, let's sit tight and maybe, not provide as much liquidity to the market until we see what happens in January, after the election in November.
Yeah, I saw that question come in as well, Bill. I don't know how to answer that. It hasn't been a part of my discussions that we've had yet. Certainly can change. Usually what we see towards the end of the year, we'll see, based on any potential policy change, we'll see the treasuries run up a little bit. And certainly I don't expect to see that this year. In fact, I was a part of a webcast yesterday that economists predicted by the end of 2021, the 10-year treasury will be 0.85. I mean, and we're talking about very little movement whatsoever. There's even been talk that we move into the negative yield range. Leslie, I can see you're in the White House now, so you must be making those policy decisions. But
me and Kanye.
Yeah, yeah. So I don't know. I mean, Joel, do you have an opinion on that?
Yeah, no, I think, we know we were going to be in for a rough ride this year with the election, just the way things have been for the last 4 years and probably for a longer period than that. So I'll feel much better once we're past November and January with the transition or the consistent, whatever the case may be. I look at, I've got a stock ticker on my computer, and again, it's the markets, and it's not at all inclusive of where we are with things. But what I guess I've noticed here more recently is there's been trends one way or the other over the last 60 to 90 days. I guess I've been a little surprised that we've been absorbing trends, maybe going away from, things staying as is and things changing. So I hope that means that if there's a change, that it's not going to send a major ripple effect that maybe some people are speculating. And if there isn't a change, that, it's probably more status quo. So again, not at all trying to get political on either side. I just feel like it'll be great for, I think, all of us to just get past this point, and we can focus on, getting everybody back and working and safe, and hopefully we have a vaccine, and things will get a lot better everywhere. So,
yeah.
Also want to remind folks that are listening, there's an upcoming NAIOP Central Ohio presentation, another Zoom call here in August, on August 12th from 3 to 4. The topic of that one, back to Leslie's most favorite property type, it's going to be industrial and logistics, onshoring and reshoring. So hopefully folks that are attending today can attend that call. From a Pizzuti company perspective, we're certainly very biased in the industrial industry. We really appreciate that asset class a lot, and all the trends that we're seeing currently affecting industrial and logistics. Chad mentioned earlier e-commerce and the rise there, and we are still very much lagging the broader world on the amount of business that's done via e-commerce, but that's certainly helping out the industrial asset class. Want to thank Leslie, want to thank Chad, want to thank Joel for their time and the perspective that they've given. I think a couple of takeaways that I heard today, and again, I think by nature, we're all very optimistic, those of us that are on this call, because we have to be, but I think we're also very realistic. It sounds like liquidity is going to continue for the foreseeable future, which is very critical, right? I mean, that's the lifeblood of lending, is liquidity. With the bank deposits that were touched on earlier and the growth there, we think these next couple quarters will have, continued liquidity. Obviously, there are certain loans and certain asset classes that are more desirable that the panel touched on. We want to keep those in mind if we're borrowers out there on the audience. Think about how you want to work with your relationship managers, as Joel touched on earlier. Those are very critical and very helpful in providing guidance. Think about how you're going to work with your, trusted advisors on the mortgage brokerage side. The folks like Chad and his team and other groups that are out there. This changing environment is requiring us to talk to lots of different banks, lots of different lenders, and it's critical that that happens. Let's make sure we also pay attention to what happens as we go into the election year, and what impact that may have on policy changes, future government incentives. Are things going to slow down or speed up by way of the way loans are being processed? I mean, those are all things that are impacting us each and every day. So, Leslie, I want to thank you for your time today. Joel, I want to thank you for your time. Chad, I want to thank you for your time today. Appreciate everybody's thoughts. Stay safe. Hope everybody's wearing their mask. Let's make sure we're doing our part to help keep the economy open and continue to perform, back to where it needs to be, to continue to allow us to see as much liquidity in this market as possible.
Yeah. Thank you, Bill.
Thanks, everybody.
Everybody.
Bye-bye.